Hello, welcome to this issue of Jimmy's Money Talk. Today's topic, S&P 500 hits record high. Is fundamental analysis relevant? Date, 19th of August, Wednesday. First, let's look at the three major index closing last night. The S&P 500 and Nasdaq has gained some points, whereas the Dow Jones has dropped 0.24%. S&P is actually proceed towards the all-time high. This is the chart of S&P 500. As you can see from this chart, S&P has been rising since July and go all the way up to last night, and it has reached a point of 3,397, which is basically the same level in February, just before the COVID-19 market collapse. So in other words, S&P has actually broadly gained ground in general. So how does it happening? Because as we read from the news, the US economy is still struggling with work, and the COVID-19 case has not been coming down, although they claim that vaccine has been found. So a lot of people are puzzled, and they are wondering that why the stock market has keep rising, but the real economy is still feeling very bad, And why does it happen? And is fundamental analysis is still applicable in today's world? And this is where we are going to look into it in today's video. So people are asking is that, okay, right now the US market has gone so much, go so much higher. Is this a good time to invest, or should we chase after it? Or if I do have some positions, do I sell them? So these are questions because people are in a dilemma and just wondering what to do. So let's look at one of the major factors that influence the stock market. It is the 10-year Treasury rate. As you can see, the Treasury rate right now is sitting at 0.67 compared to its median rate of 3.83. It is definitely significantly lower. And it is actually not too far away from the minimum, which is 0.61. So the Treasury rate is low is because, well, we know that the Fed has been printing a lot of money. And second thing is that there are a lot of people who are preserving their wealth. They just want to park their money into a safe place. And 10-year Treasury rates is obviously one of the safest place that you can park the money. And because of all this demand, therefore is driving the interest rate low. So we can understand from this Treasury rates, that's why the rates has continued to be at this low level. Next is the S&P 500 dividend yield. As you can look from this chart, the S&P 500 dividend has been falling quite a lot over the years. And right now it is sitting at 1.76%. And if we look at the statistics, the mean of S&P 500 dividend yield is 4.32, the median is 4.27, and currently we are sitting at 1.76, which is obviously quite low compared to what S&P would deliver previously. So there is a correlationship between dividend yield versus price, right? So as the price of S&P goes higher up, then the dividend yield will become lower. So technically, for investor, we want to buy S&P when that dividend yield comes to a level whereby we deem it is a fair yield, all right, a fair yield. The third thing we need to aware is the US company profit after tax versus the S&P 500 pricing. Now from this graph, you can see that the S&P has been rising continuously till today, whereas the profit after tax for US company has sort of like flattened since what, 2013, 2014, and is hovering around this range. So it is actually not a very good sign if you ask me, because when the index goes high up, the profit after tax for companies, they are not making as much profit as expected. And finally, we look at the S&P 500 PE ratios. Right now, the PE ratio is sitting at 29.14 versus a medium range of 14.83 and 15.81 mean. So it is a little high. It is a little high compared to the statistics, because as you can see over here, if anything below 25 would be probably something which is rarely occur, but right now we are sitting at 29.14. So if you ask me, the S&P PE ratios is high now. SPY is the ETF of S&P 500. So this chart itself, it shows the price versus the transaction volume with a moving average of 10 days. And as you can see from this chart, the S&P 500 sort of like went all the way up, and it has a fall in March, whereby the volume transaction shot up. But as it moved further up for the recovery, the transaction volume actually goes down. So what does it say? It says that lesser and lesser people participating in buying or rather trading the ETF. Now there are two ways to interpret it. Is that one is that people who are actually holding the ETF, they want to hold it in expecting that the ETF will go higher. Or the other way is that people who are actually outside the market, who is actually not into the ETF, they are basically now taking a back seat, do not want to enter into the stock market. So these are the two reasons that could lead to that way, whereby the price goes up, but the volume comes down. Now this could be a dangerous sign, because as any situation, or we do not know what will happen in the next 2 or 3 months going forward, but if there's any unexpected situation happens, then this S&P might just crash off directly from a high of this point. Now, of course, I'm not saying that the market is going to crash, but I'm just saying that, based on this kind of a pattern, the price is not supported by the volume itself. And that's purely on a technical analysis. So with this, I'm going to end these sessions here. I hope you all can learn something out of this. Is fundamental analysis still relevant in looking into the US market? I think to a great extent it is still, but just that we have to be very, very careful in terms of how we want to invest. At the end of the day, It is all about personality, it's about your own style. If you are a long-term investor, you probably do not want to worry too much about all these day-to-day price fluctuations and things like that. But if you are short-term traders, obviously you will need to concern the specific counters that you're buying into, and how are these macro or micro events going to affect your share price. So thank you all, and I shall see you all in the next issue.